If you're a late investor, you may be looking for investments that can start producing meaningful cash flow before you retire. But here's the question I think we don't ask often enough. What happens to that strategy when you do retire? Because while you're working, you can contribute money to your portfolio. You can reinvest your dividends. You can buy more shares. But once you retire, that may change. You may not be adding money to your portfolio. You may not be reinvesting your dividends. And instead of putting the money into the portfolio, now you need to take it out to live off of it. And that means that the investments that you found attractive while you were building your cash flow may not be the same kind of investments that you want for your retirement. So today we're putting 3 popular income ETFs head to head: SCHD, JEPI, and QYLD. We're going to be comparing their income, growth, and expense ratios. And we're going to see what happens for someone that puts in $100 for initial investment and then contributes $100 every month after that and reinvests the dividends. And I'm going to show you what I think about these positions in my own portfolio. To help me crunch the numbers, I brought in our resident data analyst, Henry.
I've been thinking about retirement.
Really?
Yes. I calculated that sunflower seeds are going to be significantly more expensive in 20 years.
That's what you're worried about?
It's a serious financial issue, Shell.
Okay, Henry. Let's start with the one that most people are interested about: income. What happened when we compared these 3 ETFs? SCH generated roughly $336 in income in this simulation. Is a dividend-focused ETF. It gives you exposure to established companies with an emphasis on dividend quality and sustainability. And this is important for my own strategy because I don't need every ETF and stock to produce the biggest possible yield. I want some investments that provide steady, consistent dividends. That's one of the jobs SCHD performs in my portfolio.
I like that. It's not trying to impress me with a giant yield. It's just showing up and doing its job.
Exactly. Now let's look at JEPI. In this simulation, JEPI generated roughly $739 in income. That's more than twice what SCHD did. JEPI combines an actively managed equity portfolio with an option strategy designed to generate income.
Now that's more interesting.
You like the bigger number?
I said interesting. I didn't say I'm buying it.
Fair enough. And then there's QYLD.
Okay, now I'm listening.
QYLD generated roughly $1,036 in income in the simulation.
That's more than 3 times SHD.
It is. And if you're only looking at cash flow, QYLD definitely looks like the winner.
That yield is tempting.
But you're not buying it yet?
No. I have questions.
Good, because that's exactly what we should be doing. There's another number we need to look at before we get too excited about those distributions: expense ratio. Because you're not just asking how much income can I get, you're also asking how much do I need to pay for this fund. SCHD currently has an expense ratio of 0.06%, so very low. JEPI is 0.35%, and QYLD is 0.60%.
So QYLD paid me the most, but didn't leave me with the biggest portfolio.
In this simulation, yes. But a higher expense ratio doesn't automatically make that ETF a bad one. You're paying for the strategy the fund is using. The important thing is to understand how those costs affect your portfolio in the long term. And when you're comparing funds with similar goals, expenses are absolutely something that I would consider.
So, big yield, higher cost, more things to investigate.
Exactly. Now let's look at something even more important than the distributions. Even with the distributions reinvested, these 3 portfolios did not end up at the same place. SCHD ends up around $122 in this illustration, JEPI is around $100, and QYLD is around $104.
So QYLD paid me the most, but didn't leave me with the biggest portfolio.
Exactly. And this is why we can't confuse income with total return. A distribution is cash coming out of that investment. It doesn't automatically mean that you created the same additional amount of wealth.
So the biggest paycheck isn't necessarily the biggest paycheck.
That's not quite what I said.
I'm I'm still working on it.
Now I want to be careful here. Many of you probably have heard about QYLD and NAV decay, and there is a real trade-off we need to understand. QYLD uses a covered call strategy on the NASDAQ 100. QYLD generates its income through call options. And that strategy does have a downside because what happens is it can limit the upside when the market does rise sharply. And some distributions can be classified as return of capital. So yes, the fund's share price and NAV can definitely behave differently than your traditional ETF. But here's the part I think many people overlook when it comes to QYLD and cover call ETFs like it. If you're working and adding money to it and reinvesting your dividends, you're not doing nothing. You're not letting it just sit there. And that's when the real issue happens with NAV decay. You can help offset the declining share price by doing those things. And that's exactly what I did when I had QYLD.
So you're not saying NAV doesn't matter?
Not at all. I'm just saying the impact can be different if you're actively putting money into it.
Okay, I can live with that. But I'm still watching the NAV.
Good. You should be. Now let's fast forward to retirement. This is where the conversation gets really interesting. When you're in the accumulation phase, you're adding money, you're reinvesting your dividends, but once you retire, more than likely that stops. You need your money that you have built up in your portfolio now to pay for your living expenses, your bills, your groceries, maybe going on a vacation. You're living off of that money. When it comes to NAV decay, this is the issue. Because you're not putting money into it, you're not reinvesting your dividends, so you're not offsetting that NAV decay or that share price decline. So yes, that is an issue.
So the hamster wheel slows down.
Exactly. And that's why I don't think the question should be, is QYLD good or bad? The question should be more of, is this tool doing what I need it to do in my portfolio?
It's okay, Shell. Then what about someone who uses call ETF to build income while they're still working? Should they switch to something else before they retire?
Maybe. But I don't think there's a one-size-fits-all answer. When it comes to cover call ETFs like QYLD, and you're in the accumulation phase where you're building up your cash flow, many people, that is the right tool for them because it's going to give you high dividends. And that's the trade-off that you make for the potential NAV decline. But once you are getting close to retirement, your priorities more than likely will change. You may care more about preserving your capital, sustainable income, diversification, and also reducing the risk of having to sell your investments when the market is down. This could lead you to shift some of your money into different types of ETFs or stocks, different strategies. For me, I am doing the 40-40-20 split. 40% growth, 40% in income, and 20% in kind of like miscellaneous real estate and stuff like that to kind of balance out my portfolio. Maybe you're not into the 40-40-20 split, but you may want more dividend income ETFs or more growth ETFs or a mixture. We all have to kind of make that decision for ourselves.
So you're not saying sell QYLD the day before you retire?
Definitely not.
Good. I don't like making big decisions at the last minute.
Neither do I. The important thing is to think about the transition before your retirement versus you are in retirement and you need that money. So which one is best for retirement income? Honestly, there is not one real answer because all of us have different goals. If you want steady, consistent dividend income and you're okay with a lower yield, SCHD might be the right one for you. If you want higher income with still an exposure to large cap equities, JEPI might be the one for you. And if your priority is maximizing cash flow and you're okay with not having as much growth or it being capped, and you're okay with you have to keep adding money and stuff like that to help offset the NAV decay, QYLD or cover call ETF might be the right one for you. Again, this is your portfolio. You know what you're looking for. And I am not a financial advisor, so everything I'm giving you here is through experience or just ideas. Definitely do your own due diligence when determining the right portfolio for you. And if you feel that you need to see a financial advisor, please do that. And now looking at my own portfolio, I have already mentioned that I have SCHD for steady dividend income, but I don't expect that ETF to do all of it. I have other ETFs and stocks in my portfolio doing different jobs. I have some that are for income. I have some that are growth. And then I also have some that are retirement and cryptocurrency to kind of give a little bit more exposure into many different types of investments. As a late investor, I need to build income. I need to grow my portfolio. I need diversification. That's why I think in terms of what is this investment doing? What's its job? Rather than which dividend or ETF has the highest yield.
I like that. Because I want income. But I also want my sunflower seeds to still be there when I'm retired.
Exactly. So what did this ETF Showdown show us? SCHD can provide a lower cost approach to dividend-focused investing and steady dividend income. JEPI can provide higher income through its equity and option strategy, but with its own trade-offs. And QYLD can provide very high current income, but you need to understand the trade-offs that come with its covered call strategy and higher expenses. The biggest lesson: don't chase the biggest yield without understanding what you're going to be giving up to get it. What I want you to get from this is that the portfolio that you're building during your accumulation phase towards retirement doesn't necessarily need to be the one that you retire with. During accumulation, you're building the machine. During retirement, you're taking money from the machine. Those are two very different jobs.
So the retirement version of me needs a different hamster wheel?
Now you're getting it. As a late investor, I don't have 40 years to make mistakes and start all over. And so that's why I'm taking my time to think about what portfolio is going to suit my needs best. And as I have mentioned before, it's the 40-40-20 split. If that's something you want to check out, definitely watch this video next. And if you watch the very end, thank you so much. Henry and I really do appreciate it. And your portfolio is yours. I am not a financial advisor. I am not telling you what to do. I am just giving you ideas. Until next time, bye.